an indication. We're going to now, I'm just going to transfer some of these properties over to the other charts. We're going to take a look at the E-mini and kind of see where it is. And as you can see from E-mini, very, very choppy type of thing when you look at it. And we're in that lower range area, tough to trade. You know, there might be some day trades that have been available in that area. You know, it's a tough to day trade too, but when we look at it, we have to consider the possibility that at any point it could break out into a trend, and we don't really know if this market, when it does make the breakout, is going to be a trending situation or not. But you know, as traders, we have to be prepared for the fact that it may not. We may have to, you know, cut our losses short, but you have to play the probabilities. You have to take advantage of the situation when it does occur. In the case of the E-mini, with the volatility it has had recently, I have put the stop point, again, this may be a little bit on the wide side, or the entry point rather, a little on the wide side, at 40 points. And so it has to get 40 points above a predicted high before I'm willing to go long. Maybe that's my bias because, you know, it seems like the market's been through a lot, had a lot of, you know, considerations why it should go lower. But so you're going to go 40% above the predicted high before you're going to get into a long position. In this case here, on October the 4th, when it, you know, the price did get down to that lower boundary that we had marked on the longer-term chart before, and you can see that's a, first of all, kind of a bullish type of a candle where the market opens in the middle of the predicted range and then moves to the top side of the predicted range, so that's bullish in the first place. You can see that we have had a turn, you know, just the initial turns in the predicted difference line. The long-term one has not turned yet, but you start to get that turn and things start to happen, start to shape up that suggest that, you know, whatever bias you might have, this might be the place that you would like to get on board a move to the upside if it becomes a trend. The predicted high that day, 11.15, add 40 points onto that, so that would mean you would be a buyer at 11.55. Now, that doesn't happen immediately. It takes a few days, but you can see that as the market has moved up, the candles look nice in terms of the person who wants to be long. 11.55, you're in, and you keep a stop at, again, 20 points below that 11.55 at 11.35. So you're still riding that market to the upside in the current situation. The stop moves up each time that the predicted low moves up. You want to keep the stop at the low, or at the highest predicted low. For today's current stop situation, the predicted low was 11.84 minus 20. That means that our stop would be at 11.64. It would be somewhere in the vicinity of this area right in here, 11.64. And you know, if the market drops that much, we're out. We have not a, you know, great profit, but a nice little profit that we can count on. And if the market does drop back then and says it's, you know, whoops, we went up and this is just another one of those little jabs, because, you know, you got to note that we are in the vicinity of this upper end of the range, and it could drop back, may respect that line, drop back. And if the market then does drop to a point 40 points below that predicted low at 11.44, you know, that could potentially be a spot to short the market again. You know, this is, as I say, it's a little trickier in some types of markets where you don't necessarily know whether the trend is occurring, but playing the probabilities, you have to play for the possibility that it will occur, and you know, hopefully the market will follow through on the position that you take. Just to summarize a little bit about you know, where we're going to be, you know, kind of what we're looking for, and talking about the situation and what's going to happen. We're going to kind of, you know, try to jump on the breakout trade if it's offered to us, but we, you know, have to do so with some caution, with some idea that we don't want to take more risk that we can possibly afford. First of all, we need to look at the market conditions in general. What market is susceptible to a breakout? And again, it has to be a candidate that is a tradable one, probably not a silver one. You know, if you're the, you know, the average trader, if you're a smaller trader like myself, but look for what's possible, what's susceptible. I can't say that word. Susceptible, and you have to then think about what perspective might change if there is surprise news, if there's an event, if you know some kind of a thing that could spark a move and, that, get a rally going somewhere, where will the surprise come from? Then how will you be alerted to that change? You don't know what will happen on the news side, but when you look at what is happening on the chart side, you can get some of the indicators that can suggest that there may be a change in the wind, or that is may be due. And so you're looking for the momentum shifts, the moving average crossovers, those types of things from a momentum type of a situation. And of course, if it doesn't work out, you have to have a plan or a strategy to act on that clue. You have to be ready to jump on the trade when it gets there. It's not just a simple I'll buy here, I'll buy there, but it's got to be when, it's got to be where, it's got to be how much, what kind of size. A lot of things go into your plan, and just as important as part of your plan, a plan of retreat if your breakout fizzles and the market breaks down instead of breaking up, or vice versa. We're not trying to hit a home run. We've got to bring in the baseball analogy here, because we're into the playoff situations, and our local team, the Milwaukee Brewers, are right in there. So we got to bring up baseball. So your idea is trying to get on board a trend, get on base with, at least get on base with a single, get yourself into a scoring position. And you can't win unless you get into a scoring position. Same thing with trading. You can't win unless you are in a position. Recognize in baseball that a hitter who bats 300 or gets only 3 hits out of 10 at bats, that's pretty good. And even in baseball, it might, return $1 million salaries. But in the case of traders, you will have many strikeouts. There'll be some times you're going to strikeouts, but you can't even bat 30% in trading and still be very successful if you manage your trades very well, manage your money very well, cut your losses short, and keep them at a minimum so that you can stay in the game. Okay, rambled through some things, and we had a little problem there with the charts at the beginning, and hopefully everything came through. Again, we're talking a concept, a type of trading, a breakout type of trading that can be modified by anybody who looks at the charts themselves and tries to define their own strategy. It's a longer-term position tape trading. It's not necessarily it's kind of the opposite side of the window of the intraday type strategy that we talked about in previous webinars, where you're looking at boundaries and saying that once it penetrates a boundary, you need to be ready to go. You need to be ready to jump on a situation when it gets you in at the earliest possible stage for a trend to develop. Now, if there are any questions, I'll be glad to try to answer those questions if I can.